Welcome to your March update. I'm Tapas Sharma, Head of Brand Design at Nutmeg. I'm joined by our Director of Investment Strategy, Brad Holland. Hi, Brad.
Hi, Tapas.
How did markets perform in February? And what impact did Russia's invasion of Ukraine have on equities and bonds?
Global equities were down 2.5% in the month, with a particularly volatile period coming at the end of the month following Russia's invasion. A terrible development that impacts the whole of Europe and beyond. Considering a poor January, that left global equities down 7.6% over the first 2 months of the year. Understandably, euro area stocks fared the worst and were down 5.2% during February. Nasdaq, that's US tech stocks, were not far behind, down 4.5%, and year to date were down 12.7%. Within fixed income, real and nominal 10-year bond yields rose 30 basis points or 0.3 percentage points year to date. And now a rise in yields equates to a fall in bond prices. Central banks outside of continental Europe continued to talk to the market about their plans to normalise monetary policy by raising short-term interest rates and reducing their balance sheets over time by selling bonds. And that weighed heavily on bond prices during February.
Governments have seemed to cooperate in their response to the war in Ukraine with strict economic sanctions. How has this impacted different investment markets and asset classes?
All governments are trying to walk a fine line between coming down hard on Russia while ensuring sanctions don't cause too much damage to their own economies. An example of this was the initial attempt to maintain Russia's energy exports. It's an awkward reality for the global system and one which President Putin seeks to exploit. As previously mentioned, European markets were the worst hit following Russia's invasion of Ukraine in the final week of February, underperforming UK, US and Asian indices. Investment market response has also been characterised by higher energy prices, a stronger dollar, and some outperformance of US and Japanese small cap indices. That's an interesting development as it shows a focus on more local conditions. Certainly the US domestic economy has remained very strong into 2022. And although many other countries have faced COVID mobility restrictions, as well as higher energy prices, the underlying economic data continues to look okay. One other response has been for money markets to reduce the amount of monetary policy tightening that had been priced in most regions prior to the invasion. And this is likely one reason smaller companies have fared better in some markets. The idea that easier policy is here for longer.
How have sanctions impacted the market indices and portfolios?
Sanctioned entities are removed from investment indices as a matter of course, as they will fail the liquidity test of most indices. That's obviously happening with Russian entities. And MSCI, the largest index provider, has taken the biggest step of removing all Russian equity securities from its global indices. On the government debt front, only new debt issuance is currently being viewed as non-investable. For now, at least, existing debt remains part of the fixed income indices, although there are industry discussions on removing it. It's worth noting also that portfolios had very little exposure to Russian securities due to their diversified nature and the relatively small portion of global stock markets that Russian stocks accounted for. In terms of removing Russian exposure, the usual protocol for index constructor and ETF providers is to action any changes at the earliest possible time, normally within a month. This time, index providers have moved much quicker, but factors such as the closure of Russian stock markets complicates the removal process.
Thanks a lot, Brad.
Thanks, Tapas.
And thank you for joining us. We look forward to seeing you again next month.